we need to talk about the banking crisis. Why do we have one? Should you be worried? What should you do? What might happen next? How bad is it? This is Kate Phillips with Total Wealth, and let's talk banks. So, yes, we've had three banks fail in the last couple of weeks that you may have heard about. A lot of talk, especially about Silicon Valley Bank and Signature Bank. Those comprise the second and third largest bank collapses in the United States. Are we done? Well, I don't think so. My clues are this. First of all, the banking all around the world has been destabilized. Credit Suisse was almost collapsing and was bought out. And there are other banks that are very challenged. As a matter of fact, a report came out about 3 weeks ago, right before the collapses, showing that over 180 US banks were unstable or were troubled in one way or another. And of course, things have only gotten worse. In the last week, we've seen, about 99 billion removed from banks, nervous depositors pulling out their money, and a lot of that were in the smaller regional banks. We've seen $500 billion removed over the last year. So we are losing confidence in banks. A week ago, we had the heads of international central banks, the United States, the ECB, the European Central Bank, Britain, Japan, Canada, Switzerland as well. They were meeting together on like a Sunday. This doesn't happen if there is no emergency. And on Friday in the US, we had again an emergency meeting of all kinds of, Janet Yellen and Jerome Powell and the head of the SEC and all of the top financial institutions were meeting. I'll guarantee you they weren't meeting to say, everything's fine. Okay, thanks, folks. So, yes, we have a crisis going on. We saw the Federal Reserve open up like an emergency lending facility a week or so ago for banks that were in trouble. And within a week, they had these banks had borrowed more money than what we saw during the global financial crisis of 2008. So this is a bigger deal, definitely, than what, the media is kind of making it out to be. Nothing to see here, no big deal, and the talking heads come on and say everything's fine and everything's resilient. And yet, when we look at the numbers of emergency borrowing and the depositors pulling money out and these emergency meetings, things are not fine. Now, okay, first of all, how did we get here? And the short story is this has been a long time coming because we have a fractional banking system that frankly has been susceptible to bank runs and collapses for hundreds of years, for as long as it has been around. That's because in a fractional banking system, you bring in $100, the bank keeps 10%, say, of that on deposit. I'll get to that in a minute because we're nowhere near the 10% now. And then that rest, that 90%, can be loaned out, can be invested, can be loaned out to depositors for mortgages and loans, etc. And so that is the system. And when people get nervous, it is sort of a musical chairs situation if you want to get your money out. And there were so many bank collapses in the 1800s, early 1900s, especially in the beginning of the Depression, that FDIC insurance was put in place, I believe, in 1934. FDIC insurance has dramatically lowered the number of bank collapses because that has given, a fairly high degree of certainty to have that insurance in place. However, if you look at what is the balance sheet of the FDIC fund compared to the total deposits in the US, and it really is only about 1.3%. Now that might sound shocking, like shouldn't more deposits be covered? I would say, yeah, that would be a really great idea. And in the global financial crisis in about 2008, we saw all of a sudden, people were getting nervous and starting to take their money out, and FDIC insurance bumped up from $100,000 per account or per depositor in each institution up to $250,000, so a 2.5% increase. Now, did we see that fund all of a sudden, double or triple? No, of course not. But it did, it did calm people down, and so it accomplished what it was supposed to accomplish. However, we could look at, what one way to look at FDIC insurance, let's compare it to home insurance. When you buy a home, or, whoever owns the home has got to take out fire insurance just in case that home burns down. Now, you're never going to have 1% or certainly not 10% of homes in the US burn down at any given time. So State Farm or whatever the company is, they don't have to have an account with, enough to cover, most homes or even a sizable percentage of homes, because even though you might have a town that, burns down because of a forest fire, you're only going to have a very, very tiny percentage burn down. But now with the banking system, when people get nervous, you might in an average year have, one bank fail. But when we start to see, large economic troubles and people get nervous, and you see all of a sudden 3 banks collapse and more deposits being taken out, I don't think we're done with the collapses, unfortunately. So we may see more collapses, more bank runs. And the FDIC insurance at 1.3% of deposits is betting on the fact that we're never going to have an enormous amount of collapses. And we'll see if that bet is true or not. If it's not true, I'm sure we'll see the Fed just, printing the Treasury and the Fed together, just coming up with all kinds of new money, which is part of the problem. We have seen the money supply dramatically increased in the last few years, both because of money printing and because of not literal money printing, but digital money printing, expansion of the money supply. And also because we had these rock bottom rates for so long, for a couple of years during the pandemic, we had rock bottom rates. That encourages lots of borrowing, and that expands the money supply. So people were borrowing, for mortgages, and that was driving the price of homes up. But because the interest rate on the mortgages were so low, you could afford to buy more house. So that led to inflation. We also had, while those rates were low, lots of corporate borrowing. So there's been a whole lot of borrowing in the system, and then all of a sudden, oh my gosh, surprise, we have inflation. So then the Fed starts raising the interest rates to combat inflation. That increases the cost of everything. It really is an attack on the economy, sort of a necessary attack if we don't want inflation to run away. But as the result of that has presented enormous challenges to these banks. A lot of, most of the banks probably had taken a lot of longer term Treasury bond, invested in these bonds and other investments that really are quite safe. But as the interest rates go up, the value of those bonds come down, and then if they need to sell those bonds before the term, as absolutely happened with those recent bank collapses, that is one reason why all of a sudden they just came up short on their balance sheets, because they were having to sell billions and billions of dollars of bonds at a loss. So We may have more collapses coming. I mentioned $99 billion flowed out of US banks in the last week, and that was primarily in the smaller and regional banks. So FDIC insurance is definitely strained right now. Some things you could do, is it time to panic? Well, yes, no, maybe your deposits are covered if they are under $250,000. However, you really don't want your deposits tied up waiting for the FDIC, to come back and make you whole again. So now is a really great time to diversify, diversify your cash. And one thing you might want to do is have some cash, like those dollar bills around, enough to cover if you couldn't access your money for several days or maybe even for several weeks. This is always a good idea because even if a bank doesn't collapse, there's all kinds of things that could impact your ability to access your funds. There could be a branch could close. We could have, a emergency, a natural disaster, a power outage, and those things would prevent you from having access to your money as well. So it's always a good idea to have some completely liquid cash around for emergencies of all types. Also diversifying your money into different banks. Unfortunately, I kind of hate to see, these smaller regional local banks weaken at this time because money's flowing out of them into the too big to fail banks, which would be, Citibank, Bank of America, Wells Fargo, Chase. And I'm not big fans of those banks, and they pay terrible, terrible, terrible rates. And yet we know that, those banks will certainly be rescued. So it may be time to diversify. Local credit unions can be a good option, but we see them challenged as well with a lot of defaults on car loans right now. So there are other places besides the fractional banking system where you can put cash, and those may be worth considering as well. There's Treasury Bonds, Treasury bills, short versus long term, and they are paying very good rates right now. And so short term Treasury bills, T-bonds, not a bad place to put some cash. There's also brokerage accounts. Something to know is that your deposits in a bank are actually a liability on the bank's balance sheet. I know that may sound counterintuitive, but it's true. And so because the bank owes you that money, it's a liability for the bank. But in a brokerage account, it is not that way. So brokerage accounts, they're actually not susceptible to those sorts of fractional banking problems. I know most people use brokerage accounts to purchase stocks or bonds, but you can also store cash in them. If you're looking longer term, not short term, a few months or something, you may look at whole life insurance. That's definitely long term. You may look at annuities. Annuities, you want to be looking probably at a minimum of 5 or 10 years, if not longer. But those are other options of places where you can keep cash. And let me know if you want to know more details about any of this. And I think I forgot to introduce myself, Kate Phillips with Total Wealth. And if you're finding yourself stressed about your money, check out the link. I've got a pinned comment right below here where you can download my Breakthrough to Abundance 22-page guide. The subtitle is 4 Reasons You're Stressing Over Money and How to Break the Cycle Forever. I go through my money maps formula, and you you can see some things you can do to just lower that stress level. I hope you found that helpful. Let me know what questions you might have. Lastly, I will say you also want to be thinking about not just diversifying your cash, but diversifying your assets. Now is also a fantastic time to pay off any high interest debt that you have, because that will immediately save you that money. And so if you've got high interest debt, again, now is a fantastic time to pay that off. Let me know what you are doing. Let me know your takeaways. Have an awesome rest of your day. And remember, you are powerful, you are prosperous, and you are free. Bye-bye.